What if I told you you might already be able to upgrade without wiping out your savings, without moving twice, and possibly still having access as safety net? Sounds too good to be true, right? Today, I want to debunk the biggest myths I hear about upgrading from HDB. Because most people don't lack affordability, they lack clarity. Hi, this is Yvette. Welcome back to my channel. Here's also a QR code where you can scan to WhatsApp me anytime. If you watched my previous video, that is part 1, where we talk about how the HDB market is stabilizing. Price growth is slowing, supply is increasing, transaction volume is easing. So now, this is part 2, where the real question is, can you upgrade comfortably in this environment? Today, we are talking about your numbers, real structures, real scenarios, and how to upgrade without overstretching yourself. Before we jump into real case studies, let's clear up a few myths that I hear almost every week. Grants need to return, 50% cash into the next flat, moving twice if I sell and buy, wiping out my savings just to upgrade. If you have thought about any of this, you are normal. Let's break them down one by one. So myth number 1, do I need to return all my grants? Short answer, yes, but not the way people think. When you sell your HDB, the grants you received plus accrued interest are returned to your CPF account, not to HDB, not as a penalty, not out of your pocket either. It goes back into your CPF account, which means that the money is still yours and can be reused for your next property. So don't let the word return scare you. The real question is, if I were to sell my HDB, after CPF refund, how much usable cash and CPF do I actually have left? Because for some HDB owners, the CPF accrued interest have snowballed over many years, and that's why you hear of the term negative sale. And this will affect your funds available for the next purchase. And that's where planning matters. Then myth number 2, second HDB need 50% cash? This one causes a lot of confusion. If this is your second HDB loan, then yes, HDB requires you to use at least 50% of the cash proceeds from the sale of your first flat. Whether is it last year, whether it is just sold, whether is it 10, 20 years ago, you will have to use that 50% of cash proceeds. And you also need to fully utilize your available CPF before taking the next HDB loan. The goal? To reduce your loan size. But that's where strategy comes in. Some of my clients choose to take bank loan instead. Why? Because bank loans don't force you to use 50% of your cash proceeds, no need to wipe out your CPF, and also offer flexibility in terms of structuring your cash flow. How much loan you want to take, how much CPF you want to use. Because sometimes preserving cash on hand is more important than minimizing your loan. So the question becomes, do you want lower loan or higher liquidity? Different households will have different answers. Then myth number 3. Do I need to move twice? Not always. For my clients buying resale HDB or resale condo next, I usually structure their timeline such that not only their finances flow nicely, they also only move once. However, some clients do decide to sell first and rent temporarily. Some buy first, some use HDB contra. There is no one-size-fits-all, so upgrading is not just about affordability. It is also about execution. Then, moving on to myth number 4. Will I wipe out all my savings? Or can I really afford the monthly installments comfortably? Honestly, this is the biggest fear I hear. And this is where planning makes all the difference. Because upgrading is not just about stretching to your maximum loan that you can get, or upgrading just because everyone around you is doing it. Yes, asset progression and retirement planning are important, and that's something I strongly advocate. But it is equally crucial for me to understand your family's numbers, needs, and long-term goals, and then align everything realistically. Because, as I always tell my clients, we can't have it all at once. But we can structure it properly. And this is where I come in. So over the years, I've helped many HDB owners upgrade, and I've never believed in upselling or pushing people into something bigger just because they can. It's never a one-size-fits-all. My approach is always very clear. First, we've got to understand the market. Secondly, I've got to understand you, your numbers, your goals, and your risk comfort. Then third, lay out the options available for you and your family. Then we weigh the pros and cons together so you and your family can make a better informed decision, not an emotional, not a rash one. So before I show you 3 real scenarios, let me ask you something. If you could clearly see exactly how much cash you'll have after selling, what your real monthly commitment looks like, and whether you can upgrade without any financial stress, would you still hesitate? If you are currently staying in a 4-room, 5-room, or even considering right sizing, and you simply want clarity on whether upgrading makes sense for you, you can scan the QR code here to drop me a WhatsApp. Even if you are just exploring, there's no obligation because sometimes one proper planning and discussion changes everything. And honestly, there's a lot more that goes into upgrading strategy than what I can cover in a single video. So now let's walk through 3 real scenarios that I discuss very often with my clients. Meet Alice and Ben, both 35 years old, 2 young kids, combined income about $17,000 a month excluding bonus. They are currently staying in a 4-room BTO that just reached MOP. And now, they are asking the same question many families ask at this stage. What's our next move? So do take note, the situation here and the numbers that I'll be running through really varies from family to family. So if you like a detailed breakdown on what may work for you, how's the financial breakdown for your family specifically, feel free to reach out to me. This is just a case study for this situation only. So in a situation like this, they realistically have 4 main paths. Number 1, stay put. Number 2, upgrade within HDB, maybe to a 5-room flat. 3, step into a private condo. And 4, if they want to unlock capital or reduce stress, they could even right size. There's no right, no wrong here. It all depends on what they value at this stage of life. So let's look at this on a higher level first. If they move to a 5-room HDB, this would likely mean that they are very comfortable in terms of budget. They get the size that they need for their growing family, and they might even shift location, maybe nearer to their parents or even nearer to the city center, nearer to work. But at the end of the day, when it comes to retirement planning, a 5-room flat is still a larger asset compared to a 4-room flat. Then of course the next option, this is where the mindset shifts. If they move into a private condo, it becomes a very different trajectory. You are looking at asset progression in a different class, potential capital appreciation, depending on whether you choose resale or new launch, but also take note, going to a private route, right, there's definitely the factor of forced savings. And also lifestyle factors in terms of facilities, environment, community for the kids. But here's the trade-off. Depending on budget, they may afford a 3-bedroom condo comfortably, but it may not be the same size as a 5-room or an executive apartment. It may not be their dream location either. So you're balancing between asset class versus space and comfort. I also want to add on this. For most families, upgrading is usually step by step. It's not like one move and suddenly you reach your dream home already. Sometimes, your first upgrade is simply more space for the kids, or better location, or just moving into a private market first. And then, your next move, maybe 4 or 5 years later, is the one that brings you closer to that dream home. And that's why planning is important, because every move that you make today will affect the options that you have later. So it's not just about HDB or condo, it's about the right step for your family at this stage that still keeps you progressing. If we were to come back to these 2 options, right, both upgrading to a 5-room HDB or moving into a condo, these both are asset progression paths, because at the age of 65, whichever asset, right, this asset is fully paid. Then from there, whether is it a 800k HDB or a 1.8 million condo, you still have the option to right size and cash out later. Now, the next option surprises many people. And if for whatever reason, maybe job uncertainty, business plans, or simply wanting to free up capital, they could right size. Move into a smaller 3-room HDB or even a 2-room BTO. Unlock cash, lower commitment, or possibly even strengthening their liquidity. Because not every move has to be bigger. Sometimes it's smarter. So assuming for their 4-room flat, right, if they were to sell at 750k, assuming they have an outstanding loan and their CPF refund their principal use and accrued interest, then minusing off agent fee, legal fee, etc., that brings Alice and Ben an estimated cash proceeds plus with their CPF available balance plus whatever that's being used is now back into their account, amounting to approximately 370,000. That brings their total available funds from their sale to $622,000. Do take note that for a BTO owner, whether it's a 4-room or 5-room flat, this vastly varies between different townships, between different value, because I do have some clients who have a higher cash proceeds, some clients who have a bit lower one. It really depends on each case study alone, so do take note that the numbers will differ. Then, assuming if they were to go for scenario number 1, which is from this 4-room BTO, they want to upgrade for a bigger space, bigger size, but yet remain comfortable in terms of their monthly outlay, let's say to a 5-room HDB. Assuming the purchase price at $900,000, then assuming that they take on a bank loan. Why is that so? Is because for a HDB loan, it will require them to take 50% of their cash, which is about 100 over 1,000 back into their next flat. Then maybe in this case, they want to free up more cash, so they decide to go with a bank loan instead. Then that brings the loan amount to approximately 675,000, which is the maximum 75% of the quantum itself. Then a minimum 5% cash because it's a bank loan. Then that brings the remaining down payment to be about $180,000. Then with buyer stamp duty, agent fee, legal fee, etc., whatever's needed, you can see over here. And even after selling their 4-room and buying this 5-room flat, right, they will have excess cash of close to $200,000 while retaining about $165,000 in their CPF, which in both cases, they do have more than enough budget in terms of their reno, in terms of their safety net, in terms of whatever that they want or they are planning for their kids as well. And even after taking this 75% loan, right, it's also a good thing to note that their monthly loan installment is only about $2,300, which with their income, right, this can be fully covered if both of them continue working at their same income. Usually I help my clients, right, I touch wood, worst case scenario, either one of them or both of them are not working, I'll ask them, is your safety net sufficient to cover in such situations? And in this case alone, you can see that the excess funds that they have are well able to cover them for years. So in this case scenario, it is very safe. How about scenario 2, if they were to choose to upgrade to a private condo? So in this case, right, I do have 2 varying budgets. I also have clients who don't earn as much as Alice and Ben. For example, they have a combined income of 10, 11,000. They are still able to do that. So as I mentioned, so the numbers really vary from family to family. So back to Alice and Ben, if they were to purchase a private condo, approximately about $1.7 million, then they are able to take on a loan of 75%. With their cash down payment of 5% over here, remaining down payment, buyer stamp duty, legal fee, miscellaneous, whatever that's needed amounts to $480,000. Bear in mind that they have available funds of $622,000. That brings us to an excess of $141,000, which even if they were to renovate, let's say 60k, 80k, they still have quite a bit of safety net for their rainy days, but yet at the same time being able to upgrade to a private condo comfortably. Then down to the monthly installments, which is something a lot of my clients are concerned. At this quantum, their monthly installment, assuming 30 years loan tenure at 1.5% interest rate as of today, their monthly installment is approximately $4,400, which this is significantly higher than whatever that they are paying for, also significantly higher than if they were to go for a 5-room HDB. But however, if we break down the numbers, in terms of monthly CPF-OA for both of them amounting to 2,900, that brings their monthly top-up to about 1,004. And if they divide by 2, both are working, both are contributing to the family, to the house and all that, right? That brings them to $730 each. At this point of time, I'll usually ask my clients, is this monthly top-up comfortable for you? Of course, we cannot just look at it, oh, I'm spending money for the house, it's just an expense that doesn't go out. It is also important to note that you are paying off an asset. And this is what I call for savings, because in the event if let's say you don't upgrade or you don't have this house, are you able to put aside this money? Are you able to save or invest this money for better use? I think that's an important question to ask yourselves as well. So the next scenario is if they were to upgrade to a condo of a higher quantum, let's say $2.2 million. I shall not run through one by one, but anyway, fast track. So the funds needed, you can see $632,000, which I admit it is very close to whatever funds that they have at $622,000. They still have to fork out from their own pocket. Of course, upgrading in most case scenarios, I will always advise my clients, we try not to touch their savings on hand. We try to also at the same time from the sale of their house to still have sufficient safety net in case for rainy days, touch wood, you are still able to service the loan. However, I have clients who are very financially healthy. They do have a lot very healthy funds on their own savings, investments. They tell me that they decide to go for this upgrade. Why? Maybe because they see this condo purchase as an asset of good value, of good potential, and they see why they want to take the step forward. And also at the same time, whatever that they have on hand, right, they have sufficient safety net because you have to top up for a down payment, and also at the same time, your monthly top up, all this have to be out of your own pocket. So it's very important to see and to analyze, discuss with your spouse especially, because this is such a big purchase. Both of you must agree and then see whether this works out for you. But that being said, whether is it from a HDB to a condo, and also at the same time, because this is just a case study, given Alice and Ben's situation, the situation may vary a lot. So it's important to have a consultation, then we work out the numbers together for you. So the next situation is if they choose to right size. In this scenario, mostly is for slightly older couples. Mainly in this situation, I named them Candy and Daniel at 54 years old. Then again, like what I mentioned earlier, are there couples who choose to right size at an earlier age due to financial reasons? There are. But most of the clients that I meet, they only do this when they are of an older age, maybe their kids move out, etc. So in this case scenario, from a $750K 4-room HDB, let's say they choose to right size to a 3-room HDB at $450,000, then maybe at this life stage, they choose to not take full loan. Maybe just a loan of $200,000. Actually, if you ask me, can they buy their 3-room flat without any loan and fully pay off the HDB? They can. But maybe in this case scenario, they choose to take a bit of loan to free up some cash, some CPF, etc. So with that, right, back to this, assuming it's a bank loan such that you don't have to put 50% cash to the next flat, 5% cash, remaining down payment, buyer's stamp duty, agent fee, legal fee, yada, you already got the gist. So here, funds needed $369,000, excess, very healthy, $252,000. So with a loan of $200,000, assuming 11 years loan tenure, 1.55% interest rate, that brings us a monthly installment of $1,600, which even with their excess funds, they can still fully pay off. And also in the event that both of them are working, their monthly CPF-OA contribution can also cover a big sum of this. So now that we've run through the options, and when we zoom out and look at everything we've covered, upgrading is not whether you can afford it. It's about whether it makes sense for you at this stage of life. For some families, upgrading to a bigger HDB is the most practical move. For some, stepping into private property changes their long-term trajectory. For others, right-sizing strengthens their balance sheet and reduces stress. There's no universal best option. There's only the best option for your numbers, your goals, and your risk comfort. And remember what we discussed in part 1. The market is stabilizing. Supply is increasing. Transaction volume is easing, which means timing and positioning matter more than ever. Because sometimes a 1% price movement may not sound like much, but that could be 40,000, 60,000, even 80,000 difference, and that's a lot. It can be your rental budget, your safety net buffer, your percentage down payment for the next place. So instead of asking, can I upgrade? Maybe the better question is, what is the smartest move for my family right now? And that answer doesn't come from copying your friend, doesn't come from chasing the hype. It comes from understanding your structure. If you are currently sitting in a 4-room, 5-room BTO, thinking about your next move, whether is it now or in 1 to 2 years time, or maybe you just want to explore a little bit, just have the slightest thought of upgrading, let's map it out properly. So in our meetup, we'll run through your real cash proceeds, your CPF and cash position, cash flow stress tests, and different sequencing strategies. No obligation, just clarity. Because sometimes one proper planning session gives you more confidence than months of guessing, just reading through, looking at the internet. If this video helped you see things differently, do feel free to like, share, and subscribe. And if you haven't watched part 1 on the market update, go and watch that as well. It completes the whole picture. And I'll see you in the next episode.